Welcome to Money and Markets, Series 5, Lesson 4. So far in this series, we have explored liquidity, exchanges, and ETFs, all operating within a single currency. This lesson crosses borders. The foreign exchange market is where currencies trade against each other. It is the largest financial market in the world, larger than all the world's stock exchanges combined. $7 trillion changes hands every single day. And unlike stock exchanges, it never closes. This lesson is about how that market works, who participates, how prices form, and why exchange rates move. You land at Narita Airport in Tokyo. Your flight was long, you are exhausted, and you need train money. You walk to an exchange counter and hand over $200. The clerk slides back 29,000 Japanese yen. No explanation, no negotiation. Just a rate printed on a board. That rate, 145 yen per dollar, exists because of a vast, continuous market operating 24 hours a day, 5 days a week, across every time zone on the planet. The foreign exchange market is the largest financial market in the world. About $7 trillion changes hands every single day, more than all the world's stock exchanges combined. This lesson is about how that market works. Every foreign exchange quote involves two currencies. The first is called the base currency. The second is the quote currency. The number tells you how many units of the quote currency you get for 1 unit of the base. Euro to US dollar equals 1.09 means 1 euro buys 1.09 US dollars. US dollar to Japanese yen equals 145 means 1 US dollar buys 145 Japanese yen. The first currency listed is what you are pricing. The second is what you are pricing it in. To go backwards, to find how many euros $1 buys, you take the reciprocal. 1 divided by 1.09 equals about 0.92 euros. The three-letter codes are universal. USD for US dollar, Euro for Euro, GBP for British pound, JPY for Japanese yen. When you exchange money at the airport, you are trading at the spot rate. The exchange happens now or within a day or two. But what if you are a company expecting to receive payment in a foreign currency 3 months from now? You do not know what the spot rate will be then. Could be favorable, or it could wipe out your entire profit margin. This is where the forward rate comes in. You lock in today the rate at which you will exchange currency on a future date. Forward rates are not guesses about the future. They are derived mathematically from the spot rate and the interest rate differential between the two countries. If US interest rates are higher than Japanese rates, the forward rate gives you fewer dollars per yen than the spot rate. The math ensures no free lunch. No single authority sets exchange rates. They emerge from a continuous global auction. The largest participants are central banks, commercial banks, multinational corporations, institutional investors, and hedge funds. Central banks occasionally intervene, buying or selling their own currency to resist movements they find destabilizing. Japan has done this repeatedly to support the yen. China manages its yuan within a controlled band. But most movement comes from the market itself, from millions of decisions to buy, sell, or hold assets denominated in different currencies. When a US company buys a German factory, it needs euros. It sells dollars and buys euros. That single transaction, multiplied by millions like it, moves the rate. When investors believe the Federal Reserve will raise interest rates, they buy dollars to earn more. Dollar rises. Here is one of the most elegant ideas in international finance. Take two investors, both starting with $100. One invests in the US at 5% for 1 year. The other converts to euros, invests in Europe at 3%, and locks in today the rate at which she will convert back. In theory, both should end up with the same result. If they did not, everyone would rush to the better option, and the flood of activity would restore equality. This is called covered interest parity. The forward rate adjusts automatically to prevent the free lunch. If US rates are 2% higher than European rates, the forward rate will reflect an expected depreciation that exactly offsets the interest advantage. This relationship holds remarkably well in normal times. In crises, it briefly breaks down, revealing stress in global dollar funding. Covered interest parity assumes you hedge your currency exposure. But what if you do not? What if you borrow in a low interest rate currency, say Japanese yen at near zero rates, and invest in a high interest rate currency like the Australian dollar? You earn the interest rate differential without hedging. This is the carry trade. The strategy can be enormously profitable, right up until it is not. The problem is crash risk. Carry trade positions unwind suddenly when investors panic. Everyone rushes to buy back the borrowed currency at the same time. The low-rate currency surges. Losses are sudden and large. In August 2024, a sudden unwinding of yen carry trades sent global equity markets into a brief but sharp tumble. Japan's stock market dropped 8% in a single session. If you can trade three currency pairs, say euros to dollars, dollars to yen, and yen back to euros, and the prices are not perfectly consistent with each other, you can make a riskless profit. This is triangular arbitrage. Start with $100. Convert to euros. Convert your euros to yen. Convert your yen back to dollars. If the rates are consistent, you end up with exactly $100. If they are not, say you end up with 101, that is a free lunch. In reality, such inconsistencies exist for only milliseconds. Electronic systems close them almost instantly. But this arbitrage is the reason exchange rates across currency pairs are tightly linked. Consistency is enforced by the profit motive. Over short periods, exchange rates are driven by data releases, jobs reports, inflation numbers, central bank decisions. Traders react instantly. Over months, three forces dominate. Interest rate differentials. A currency with higher rates attracts investors. Demand rises. Currency strengthens. Inflation. Higher inflation erodes purchasing power. Investors sell currencies losing value quickly. Economic growth. Strong economies attract investment. Capital flows in. Demand for the currency rises. Over the very long run, a useful benchmark is purchasing power parity. The idea that exchange rates should reflect relative price levels between countries. If a coffee costs $8 in New York and €6 in Paris, the implied fair rate is $1.33 per euro. The Economist tracks this with its famous Big Mac index. For a multinational company, exchange rates are not a curiosity. They are a source of real profit and loss. Imagine a US company that manufactures in Europe and sells in the United States. Its costs are in euros. Its revenues are in dollars. When the dollar weakens, its costs in dollar terms rise while revenues stay flat. Margins shrink. Companies hedge this risk using forward contracts and options. A forward contract locks in the future exchange rate. An option gives the right, but not the obligation, to exchange at a fixed rate. This is not speculation. It is risk management. The goal is not to profit from currency movements. It is to remove the uncertainty so the business can focus on what it actually does. The foreign exchange market trades $7 trillion per day. It is the world's largest financial market, open 24 hours a day. A currency pair shows how many units of one currency buy 1 unit of another. Euro to US dollar at 1.09 means 1 euro buys $1.09. Spot rates are for immediate exchange. Forward rates are locked in today for future delivery, and the math of covered interest parity links them to interest rate differentials. The carry trade earns the rate differential without hedging, but risks a sudden crash when positions unwind. Triangular arbitrage enforces consistency across all currency pairs. In the next lesson, we move to physical goods: wheat, oil, copper, gold, and the futures market that lets you agree today on tomorrow's price.